Imagine this. It's September 1929, stocks are soaring, and economists are tweeting, well, speaking confidently, that prices have reached a permanently high plateau. Investors bought stocks as if they were golden tickets, borrowing money to buy more, convinced the party would never end. Fast forward to today, AI stocks dominate headlines, markets hit record highs, and everyday investors are piling in like it's the newest Black Friday sale, only with bigger promises. So the million-dollar question, or should I say trillion-dollar question, is this: are we living in 1929 redux? Is this bubble a march toward a devastating crash in 2026, or is history merely rhyming rather than repeating? Let's explore that with facts, not fear. The crash of October 1929, culminating on Black Tuesday, was not a single daily tragedy. It was the result of years of buildup. The U.S. economy had expanded rapidly through the Roaring Twenties, but so had speculation in debt. Ordinary Americans were not just spectators, they were participants, borrowing to buy stocks on margin, meaning they put down as little as 10% of the cost and borrowed the rest. This leveraging inflated stock prices well above real earnings, turning Wall Street into a house of cards. Then, when prices finally dipped, margin calls forced selling that hit like a wave, driving prices down further. It wasn't just gamblers losing money. Banks were exposed too, and bank runs followed, freezing credit and sending shockwaves through the economy. One critical point is that the 1929 crash wasn't just about stocks. It revealed structural weaknesses, weak banking regulations, overproduction in key industries, and an agricultural sector already in recession. The result? A collapse that spiraled into the Great Depression, where the Dow lost nearly 90% of its value by 1932 and took decades to recover. Now, let's talk about today, specifically 2025/2026. There's a lot of chatter online, and some data suggesting parallels to 1929. For instance, margin debt levels in recent years have climbed very high by historical standards. A few financial analysts note that the only time margin has been this elevated was back in the 1920s. That means more people are borrowing to play the markets, just like they did nearly a century ago. But it's not just margin trading. We also see valuation metrics stretched, especially in big tech and AI stocks. Recent warnings from institutions like the IMF highlight that stock valuations are well above fundamentals in many areas, a condition that, historically, increases the odds of corrections or disorderly market moves. Markets are heavily concentrated, with just a few megacap names making up a huge chunk of the S&P 500, which can amplify market moves in either direction. And then there's investor psychology. Just like in 1929, you'll hear people today saying things like, "This time is different." That phrase has appeared in every bubble, from the dot-com era to the 2008 housing boom. But history shows us that it rarely is different for long. Let's be clear, despite eerie similarities, the world of 2025 to 26 isn't the world of 1929, and that matters. First, financial safeguards are far stronger today. After the Great Depression, the U.S. government created tools like deposit insurance and tighter banking regulations to prevent massive bank runs. And after 2008, additional reforms like stress testing and capital requirements made the system more resilient. These tools didn't exist in 1929. Second, market mechanisms like circuit breakers can slow panic selling, giving regulators time to act, something unimaginable in 1929. And the Federal Reserve now has a playbook to inject liquidity, adjust rates, and stabilize markets quickly when needed. Third, the nature of the economy has changed. In 1929, manufacturing and agriculture dominated. Today, services and tech lead the charge, an economy far more diversified and globally integrated. That doesn't make us invincible, but it does mean a crash wouldn't necessarily play out the same way. So the honest answer isn't, yes, we're doomed. It's more nuanced. We're seeing signals that deserve respect and caution, but not a rerun of the 1929 depression. Here's where the conversation gets interesting and useful. The real risk today isn't a one-day wipeout like Black Tuesday. It's something more modern and subtle, a disorderly correction. Markets have climbed on optimism, low yields, and massive liquidity for years. When valuations stretch, corrections, not full-on depressions, have historically been more common, especially in advanced economies with safety nets. For investors, that means preparing wisely. Diversification, risk management, and reducing leverage aren't sexy topics, but they're what keep portfolios standing when optimistic headlines fade. And remember, markets don't need to crash to punish investors. They only have to stop going up for strategies based on constant growth to fail. So here's the bottom line. Are we living the 1929 crash again? Not exactly. History isn't a movie remake. It's more like a remix. It borrows familiar themes, but different instruments play them. We do see bubbles, elevated debt, and exuberant optimism, the same ingredients that contributed to the Great Crash. But we also have safety nets, sophisticated monetary tools, and far more diversified markets. If there's one smart takeaway here, It's this: history tends to rhyme, not repeat. When too many people believe in perpetual growth, tough lessons eventually follow. But that doesn't mean we're destined for a 1929 replay. It means we should learn from 1929, not fear it. If you want more deep dives with real data, charts that tell stories, and insights that actually help your financial decisions, not just scare you, hit subscribe. Because in markets, understanding beats panic every time.